Hello, my name is Jody Samuels, trader, coach, and author from fxtradersedge.com and ElliotWaveDesk.com, known for my expertise in Elliott wave analysis and the convergence of Elliott, Fibonacci, and harmonics. In this video, we discuss cross-market analysis and clues we can look for when trading our individual markets. Please read this disclaimer to yourselves. The cross-market approach. It used to be the case that retail forex traders only focused on currencies, stock traders only looked at stocks and indexes, bond traders only looked at interest rate products, and commodity traders only looked at their specific commodities. However, nowadays, any trader, regardless of their specified asset class, will be curious about currency trends to gain a better understanding of money flow. On top of that, traders will also follow commodity prices to gauge inflation and hence allow them to predict monetary policy decisions from the central banks. In today's global economy, it is crucial to look at what is happening outside of our own backyard and to piece together a picture of the entire market. For example, what happens in China and Japan affects Fed rate decisions. During my 14 years of experience working as an institutional trader at JP Morgan in the 80s and 90s, cross-market analysis was crucial in gaining a broader perspective of the markets. Today, with the increasingly interdependent global economies, a sound cross-market approach is mandatory to maintain an edge trading the markets. All markets are related, and by looking at the dollar, commodities, stocks, and bonds, one covers the bases. In an inflationary environment, rising commodity prices imply higher inflation, higher interest rates, a weaker dollar, and eventually weaker stocks. However, in a deflationary environment such as today, higher commodity prices imply economic growth picking up and therefore a potential pickup in inflation leading to a weaker dollar and stronger stocks. However, at any point in time, there are various drivers affecting these relationships. For example, during the 80s and 90s, we evidenced disinflation, which resulted in a decrease in the rate of inflation, such that global interest rates peaked and continued to fall over the next 20 years. As this environment unfolded, the dollar rose in value, where gold sold off substantially. Current times are being called deflationary, with very low and sometimes negative interest rates. Looking at this gold chart, which is adjusted for inflation using CPI on a logarithmic scale, one can easily identify the three different periods on this chart. The 70s being the inflationary period where the price of gold rises and interest rates skyrocket. The middle period between the 1980s and the year 2000, where gold relentlessly drops as interest rates topple with disinflation. And then the third period begins after the year 2000 with gold moving up again. So gold starts to rally in early 2000 and peaks in August of 2011. 2001 marked the turning point for gold as the bull market in stocks was ending and the dollar was peaking. It's right over here. Historically, gold and the US dollar have an inverse relationship, such that when gold goes up, the dollar goes down, and vice versa. Investors were confused, however, since gold historically is an inflation hedge and interest rates continued to decline. In other words, there was no sign of igniting inflation and the environment was deflationary. One explanation is gold's role as a store of value during economic uncertainty and an alternative investment to the dollar. Also, the projected dollar weakness could potentially create inflation and trigger a move up in gold. So again, this is the US dollar index. It shows the US dollar index peaking in 2001 when gold bottoms. This is a chart of the US dollar index overlaid with gold, and it shows the clear inverse relationship and the clear turning points in both gold and the US dollar index. So this is where the US dollar peaks and this is where gold bottoms, and then moving along to the right, this is where gold peaks and the US dollar bottoms. So this correlation is very, very interesting, and this has held up over time since the 70s. The next relationship we're going to take a look at is the relationship of the S&P 500 index to gold. The 1970s, which was a period of persistently high inflation and led to a rise in interest rates and a move out of stocks and into gold. So that's evident here. When price moves down, that is the equivalent of investors selling stocks and buying gold. During the 1980s and the 90s, so from this point until this point, we saw this ratio move straight up as investors bought stocks and liquidated gold holdings. And when stocks crashed in early 2000, investors poured money into gold, so stocks went down, gold went up, given that it is often viewed as a safe haven asset. And since 2011, we've seen a move into stocks and out of gold as investors were more inclined to choose risk-on paper assets like equities as opposed to physical assets like gold. And so far, 2016 has seen the ratio move down with a move into gold. Finally, I'd like to mention the correlation between the S&P 500 to the 10-year U.S. Treasury bond. Prior to the late 1990s, the traditional relationship existed between stocks and bonds. Namely, both moved up and down together. Since the late 1990s, however, stock and bond prices have decoupled and now hold more of an inverse relationship. Stocks and bonds trade in the opposite direction. During financial uncertainty, investors bail out of stocks and move into safe haven investments such as U.S. Treasuries, and we call that a risk-off environment. On the other hand, in a risk-on environment, investors move into stocks and sell bonds. If one looks at the charts going back several years for the S&P overlaid with the 10-year U.S. Treasury bond, and here's an example going back a year, there are many turning points in the S&P 500 which line up with the turning points in the 10-year bond. And on this chart, you can see those turning points in magenta. Now, naturally, this is all very general in that I'm talking about the S&P Index versus the 10-year U.S. Treasury bond, and we're only talking about the U.S. markets. But this certainly applies to all of the global markets as well. And there's also an awful lot more to say about it. So this is just scratching the surface. Bottom line, these cross-market relationships can sometimes forewarn of a move in another market and should be followed on a regular basis. The focus of this series of articles will be to look at the global markets going forward and continue to analyze these correlations in order to better understand how the markets unfold. I want to thank you for watching this cross-market analysis video. And if you enjoyed this video, please like it and subscribe. See you in the next video.